Okay, folks, welcome to a brand new trading week. We are getting ready for the futures to open, and they are off. We have the NASDAQ 100, the NQ, opening up here 0.11%. Let's let this settle down here a little bit because I'm really curious about the open here. Well, because what we saw, I'm going to talk more about this in a little while. What we saw over the weekend was a risk asset, also known as Bitcoin, which everybody knows trades 24/7. It took it on the chin this past weekend, and it undercut the lows of Friday. Now, there's a 93% correlation between Bitcoin on a weekly time frame and the S&P 500. Again, I have that chart. We'll talk about that in a few moments. So I want to put that out there and make sure that everybody is aware of that correlation. I don't know why my screen looks like that's better. What happened to me now? Let me try to fix my picture-on-picture here. And we will try to get this right. All right, we're going to keep it as is right now. All right. So, we're seeing a little bit of selling pressure here. I will say this, despite my negative comment with regard to Bitcoin and the correlation to the S&P 500, you take a look at the price action on Friday. I mean, it was outstanding price action, very powerful. Dow Transports, very, very broad-based. So it's going to be an interesting open here. It's going to be a very, very interesting week. Wow, we're struggling to stay positive. Let me see if I can fix this screen. It's probably driving you people crazy as well. There we go. A little bit better. A little bit better. There we go. I think that's better. Okay. All right. So it looks like we're holding green here at the open. Let's check in with the E-minis. My guess is they're going to look about the same. And yes, we're up spot 0.04%. Same thing as the NQ. Now, what really rocked on Friday was not necessarily the mega cap names. It was the small cap names by far. They were up about 4% RTY. And they're opening up green here. Again, off of session highs, similar to the mega cap names. Let's check in with the mid caps. We'll take a pause here and say hello to folks. I didn't put up my chart request in the members area. I knew I didn't do something. EMD opening okay here, but this is very, very thin volume. Very, very thin. Let's just check back in with the NQ, see how it is doing. It looks like it's regained some of its footing here. Let's set up some alerts. Oh, we just took out lows. We went red. We can't be the least bit surprised if we get a pullback here. I mean, on Friday, that was just a massive, massive rally. And we closed just off the highs of the day. So let's put things in context. Okay, we have our alert set. So no sense in just sitting here watching. Let's say hello to folks. Wow, we have a lot of people. Good stuff. Folks, if I could ask you to like, subscribe, you know the deal. Please hit that notification bell for future live streams when we go live. Members, I did not do the week ahead commentary. I went out to the Hamptons with my father. So I'm going to do it tonight live with everybody. And this is where what we do every weekend, usually on Saturday, do the week ahead commentary. I go through the weekly charts, see how they close, and we come about a strategy. And hello, Talon. Welcome, brother. Mr. Pete, welcome. Lee Cable, good evening to you. Mr. Sean, gentleman, the scholar. Larry, the future is not certain. Stay liquid and unlevered. Yeah, I mean the leverage portion, no doubt. If you're going to stay illiquid, use a trailing stop. George, welcome from Quebec. Yeah, you're 1,000% right. Let me fix that now. Let me just put this up here so people can see what the heck I'm doing. We're going to take out another alert in about 2 seconds. NQ is now firmly red. Okay. My traditional popcorn, and we are good to go. If you're not a member of our community, no credit card required. Head on over, sign up. It's free. Okay, let's get back to the futures. Yeah, we're getting ready to take out this support level here on the NQ. Let's take a moment. I want to finish with the comments. George, thank you again. Yes, Franklin, sorry about that. It's fixed. Wow, everybody's on me about this. I think it's done. I apologize. Hi, Bob. Hey, Paul. Welcome. SK. Hey, Bob. Hey to you. Hope you're doing well. You're very welcome. Thank you for being here. Much appreciated. Please enter it in that live stream, please, because I won't remember, and it's very difficult with all these comments to go back and find them. So if you could do that for me, that would be great, and I'll definitely go over it. Paul, face raised orange Trump meme coin down 88% of the side. I don't know why people invest in that stuff. It's got me by the short hairs. Greetings from Sisley, LA. Well, welcome. Yeah, stay away from the meme coins, no doubt. Okay, let's check out Bitcoin. I want to go back to what I was talking about earlier about Bitcoin and how over the weekend really it's not unusual for it to be volatile, but man, in light of the price action last week, a risk-on appetite for stocks, crypto, etc., you would have expected a benign weekend, getting ready for follow-through. Didn't happen. And there you have it. Bitcoin just getting crushed here at the open, down 3.22%. Now, on the futures market, we haven't taken out the lows of Friday, but on the we have taken out the lows of Friday. Here, let me just go to it and make sure I'm right first before I get all too excited. Yeah. So this is the weekly chart of Bitcoin down 3.9%. Let's go to the daily view. And on the daily view, we have more than taken out the lows of Friday. So this probably has something to do with the 24-hour, 7-day-a-week trading. But clearly, we are down below, far down below the lows of Friday on Bitcoin. So this is not looking good. And again, what I want to draw home here is this. Going back to that weekly chart, up here, I have correlated Bitcoin, and I said S&P 500 earlier. I actually have it the triple Qs. They are 93% correlated. 93% correlated. Let's check out the S&P 500. Also 93% correlated. All right, so no great shock here. So keep that in mind. Bitcoin getting walloped. We've taken out the lows of, and we just sold off more. Taking out the lows of Friday. Let's check back in. I don't think the alerts fired off on the NASDAQ 100. I didn't hear them anyway. Not a lot of selling here. We have the E-minis now red as well. Not a tremendous amount of selling. And again, they're stopping short of taking out support levels. So there are buyers in here looking to support the market. Hey, Pat. Yeah, it was crazy. It was really an amazing. Powell crafted that speech absolutely perfectly. Now, there are obviously going to be a lot of downsides to the policy, but in the short run, it's going to be friendly for risk-on assets. I can't argue with it. The problem is do longer-term yields respond as they expected? And arguably, the answer to that is no, because we've seen most recently there's more selling coming in here. When they began almost a year ago, the 10-year yield, which is what they're trying to get down, along with the shorter duration yields, because that's what we're financing our debt with, short-term notes, not 30-year debt. We're going very, very short-term, and because really the Federal Reserve can only control that. And they need to roll over a lot of debt. So they need to get yields down. They're saying they want them down to 2%. It's going to take a lot of Fed intervention here to get them down to 2%, because 1 year ago, September, we had the beginning of a 100 basis point cut. Where are yields now versus this time last year? Higher. All right, so we got some buyers that move in here. Let's go on. Let's check it out. The dollar. The dollar did not close well last week at all. I mean, look at this price action on Friday. They're going to inflate away our debt using dollars that are basically worthless. That's what they're going to do. So inflation, it's not a matter of if, it's a matter of when it makes a comeback. Checking out the weekly view of the dollar, we attempted to recapture a support level, right? So this is what I always talk about. The week of the 11th of August, after a multi-week rally on the US dollar, we broke this support level in purple. Then last week, we rallied, tried to recapture, were rejected, especially on Friday, with the very dollar bearish testimony that came out of, not testimony, speech from Jackson Hole. So not good price action at all. Let's check in with the euro and yen. Euro up first. The euro is down at current, but I'll tell you the weekly chart looks pretty good here. We broke out the week of the 18th. Looks like we're going to do a check back and probably get follow through to the upside on the euro. Japanese yen is also down. It's very strange to see the dollar down. I got to double check to make sure we haven't recovered. Now we're up on the dollar. Okay, so now that makes sense. So longer term, I think that the dollar is going to weaken up here and euro yen are going to go up higher. Bonnie Bean, do you think we may get a fake out, then maybe a higher mark, then make higher in the markets for rolling over in September? You know, you could argue that we've already had the fake out on the triple Qs and on the S&P 500. So the breakout point failure really hasn't been, or bull trap really hasn't been negated as of yet, except for the Dow Jones Industrial Average. The S&P 500 and the triple Qs, the Mag 7 names, they haven't really, they recaptured support levels, but they haven't taken out all-time highs yet. So we had a little bit of a head fake breakout there. Let's see whether or not they can continue this up higher. I mean, monetary policy, fiscal policy, there's plenty of liquidity coming out there. The question is, do earnings keep up? You know, you had interest rate regime with lower interest rates in the latter half of, or just after the dot-com bubble. Didn't matter. It didn't matter because you had earnings that were coming out just horribly. So earnings are going to matter here a lot more than usual. And we had a good earnings season, but was that caused by corporations pulling demand forward because they were worried about tariffs? So that's one thing I suspect may have happened. Let's check out, I know I'm missing something here. Let's check out gold. Gold is getting ready. I'm going to keep it on a weekly chart. I mean, gold is getting ready for a huge move here. And when I say gold, I mean the mining stocks, I mean the metal, I mean silver, the silver mining stocks. I mean, look at this consolidation here. Very, very tight, very crisp. Good stuff. Let's see how we're opening down at current. Silver also opening down just shy of a 0.5 percentage point. But again, folks, it's the macro view, that weekly view. Look at this. It's beautiful. We broke out last week. So silver broke out. Gold is getting ready to break out. I think they're the place to be honest with you. Let's check in with, I know I'm missing something. Let's check out bond yields. Now, bond yields got crushed last week. Let's bring up the big chart. Let me illustrate. So we broke out. This is the 10-year yield. The Federal Reserve cannot control the 10-year yield. Many people think they can. They cannot. The only way they can control the 10-year, 20-year, 30-year bond is to buy that bond, manipulate the bond market. It's called yield curve control, also known as quantitative easing, also known as monetization of our debt. So the bond yield broke out the week of the 11th, failed to hold last week, but we have a gap up this week so far. And let's see whether or not we get an inside week on the 10-year yield. But the biggest nightmare has to be for the Federal Reserve right now is that they cut rates, overnight rates, and then the longer end of the curve goes up. That means the yield curve just explodes higher, and that's exactly what happened on the month. If we're going to go to a monthly chart of the yield curve, 2s versus 10s, 2-year yields versus 10-year yields, and I'll tell you, that chart should be scary to anybody that's watching it. All right, so we did bonds. What's volatility doing? Vol got crushed on Friday. Front month contract has a 17 handle. NQ is not covering here, but it is holding support. Let's check in with Bitcoin again. I think it's really fascinating price action, what we're seeing on Bitcoin right now. Now down 3 1/3%. So we're just right at the lows of the session on Bitcoin. Let's just check in with XRP. XRP down 2%. I would argue that this chart's a bit more bullish, not as extended as Bitcoin. And we broke out here the week of the 18th. Looks like we're going to retest. So still bullish on XRP. Bitcoin, a little bit of a problem child right now. Do you think it's possible in 2026 the 30-year bond will be backed by gold? No. I would love it. I would love for the currency to be backed by gold, but no, it's not going to be backed by gold. They have no intention. At worst, you get paid the spot price, so not a big deal, not horrible. Chubby Charles, welcome. Okay, let's get to it. Let's go to a really quick overview of where we stand going into the new trading week with regard to our announcements that are coming out. Economic data coming out first. We have new home sales. That should be interesting. Fed heads coming out Tuesday. Durable goods, very, very important. We've seen some horrible numbers here. And for those folks not familiar with what durable goods are, those are washing machines, dryers. They're big ticket items that last several years of a lifetime. So those are your durable goods. I always say washing machines, dryers, refrigerators. Think of along that realm. We have consumer confidence coming out, huge. Nothing on Wednesday. Thursday, we get, and this has been ticking up, initial jobs claims ticking up. GDP, first revision, that should be interesting. Pending home sales. Friday, personal income. So Friday's going to be a very, very interesting day in that, first off, I refuse to believe that Powell didn't know the PCE number before he gave the speech on Friday. But then again, he had all the data that should have picked off the 2023 regional bank crisis, but he didn't pick that off either. So Friday is the PCE report. That is like the CPI, PPI report, but it's the Federal Reserve's favorite measure of inflation. If that comes out hot, it's not good. They're going to be think about it this way, where I'll probably repeat this several times tonight, but we are going to enter a new rate regime or continue with the 2024 rate regime, whatever context you want to put it in. I consider it a new regime. They're going to cut interest rates with an economy which is supposedly growing as expected here at 3.1%. 3.1%. The average is 2%. So the GDP is growing above the average. We have inflation nowhere near 2%. It rose year over year. We have equity valuations, which we're going to talk about in like 2 minutes, on certain metrics at all-time record highs. At least the best case scenario, we are at the second highest valuation on record. Yet they're going to cut interest rates. We know the reasons why, but they better hope that the outcome is what they expected. And we'll talk about, I'm teasing why they're doing it, and stick around, we're going to go over it. So Friday's going to be a big day Because right now we're going from the Federal Reserve is going to cut rates. Now the question that becomes, okay, by how much? And is it enough? So just because they came out with this announcement, the markets had a great rally, doesn't mean we go skyrocketing up higher immediately. There's not enough clarity. Do I think we're probably going to move up higher? Yeah, I do. Is it warranted? No, we're very, very expensive. But my opinion means nothing. Rationality has gone out the window now. We're back to the dot-com era. For those folks that weren't trading back then, which I'm guessing at least 50% of the people on this live stream now weren't, I was there. And believe me, there was no sense of fear whatsoever. And everything was going wrong. So earnings going like this, yet stocks going like this. I can't believe we're back here, but we are, and we'll make the best of it. So Friday is going to be a huge day for equity markets in terms of earnings. We're winding down here, but we still have big names coming out, and obviously the Pimp Mac Daddy of them all is going to be on Wednesday after the bell, which is NVIDIA. Lots of retailers coming out on Thursday. Best Buy. And really, that's it. This is going to be an interesting one here. Affirm. I call this buy now, pay never, because people have tapped out on their credit cards, and now they're using buy now, pay later. And again, I call it buy now, pay never. And that's how they're purchasing goods. That's how they're keeping this consumer alive. It's crazy. FedWatch tool, probability of an ease going out and into September. We are at 85.3. So they are going to go. They're going to go. Now, in terms of valuations, this is what you call the Shiller PE ratio, also known as the CAPE ratio. Here, we are at the second highest valuation in history. Prior to that was the dot-com bubble. The Buffett indicator. We have now gone from overvalued to strongly overvalued. This is the total stock market value, not the S&P 500, but the total U.S. stock market. I guess it's the Wilshire 5000 relative to GDP. So the stock market is 217% larger than the GDP of the United States. And look at where we are. I mean, my God, we are well above the 2 standard deviation move on this metric. I mean, and they could quite possibly send stocks up higher here. Now, the mind blower, you would think that this is enough, right? This is enough. I mean, on the Buffett indicator, we are now well beyond, for a while now, well beyond the dot-com bubble. It gets better. Here. This one is for the history books. The combined valuations of the U.S. stock market have hit an all-time record high. This goes back a long way. This surpasses the peak of the dot-com bubble and the highs seen since 1929, right before the Great Depression. This is a combination of trailing PE, forward PE, CAPE, which you just went over, the Shiller PE ratio. It's an average of all of these metrics, and we are now more expensive than any time in recorded history when you average out all of these valuation metrics. It's really an interesting time to be alive. It really, really is. Scary, to be honest with you. All right, so if you're wondering why is the Federal Reserve going to cut rates? Why would they ultimately go back to quantitative easing? It's simple. We are now $37 trillion in debt. That does not include unfunded mandates. What's that? Social Security, Medicare, Medicaid, all these social welfare programs. They're just addressing the headline number, which is the $37 trillion, and we are paying now 1.2 trillion. It said an alert fire off. Enki just broke below the lows of the session. Let's check out the volatility there. Nothing mind-boggling here in terms of volume. It's a flat open. Okay, so our interest payment on our debt, this is what all of this comes down to. Powell's speech on Friday has everything to do with the fact that we are about to pay $1.2 trillion in interest payments out the door on our debt. And it's only going up higher. It's not as if that we're paying down our debt. The reason why the stock market is at these current valuations is not because of the Federal Reserve cutting rates last year. It's because the Treasury continues to spend money like a drunken sailor. Congress. So here we have it. Over the past 48 days, the U.S. federal debt has surged by $1 trillion or $21 billion per day. The world thinks we're nuts. If you're wondering why we're cutting rates, yet longer-term bond yields are going up higher, the world is saying, you're crazy. This can't end well. Since August 11th, the U.S. has added $200 billion in debt. Why is the U.S. government spending running at World War II levels in a strong economy? And to put things into further context, we had emergency spending that was brought on by COVID. That spending is only increased after COVID with no emergency. It's just, we're just an out of control train at this point. And affordability of housing, one of the other goals they're hoping for, and it's a long shot at best, is that if they cut interest rates, it'll make housing more affordable. Well, the housing market is based off of longer-term yields. The mortgage rates are based off of longer-term yields, not overnight funds rates. So if the 10-year, the 20-year, 30-year bonds move up higher, well, affordability of housing only gets worse. And here is something that's going to get, I can't really put words to how bad this is going to get. The U.S. dollar's purchasing power over the past 100 years has lost 95% of its purchasing power. I would argue that 95% came since 1913. What happened in 1913? The institution of the Federal Reserve, the income tax, and the IRS. That is the very point from which the devaluation of the U.S. dollar crumbled. And then in 1971, when Nixon took us off the gold standard, that's when the floor just fell out. Now, the Federal Reserve, the balance sheet, they continue to roll off debt here. What's got to happen to get the longer-term yields down is that they need to increase their balance sheet. And I was listening to Peter Schiff today. He's saying that they need to add another. They did some analysis on Grok. They need to add another $10 trillion. In short, bring their balance sheet up to around $17 trillion to get to a 2% target on the 10-year yield. Think about it. And it's clear what's going on here. Never before in history has that. Well, I shouldn't say in history. It's very, very rare for a Fed governor to resign, and this hasn't gotten a lot of news. And I found out about it recently, and it's Andrea Klugler submits resignation effective the 8th. Immediate. She's gone. This is posted on, this is a press release out of the Federal Reserve. Who do they put in? A friend of the administration. Now, they also have their lens on Lisa Cook. Apparently, there may or may not have been, this is just, I have no idea. This is what is being reported, that she had some shenanigans done within a few days of mortgage applications, and she's going to be gone soon. And they will fill her spot with a Fed governor who's very, very friendly to the administration. So this is happening. It's basically the independence of the Federal Reserve is getting chipped away at, because what has to be done here, I'm not saying it's the right thing, is that they need to boost the balance sheet of the Federal Reserve. Long story short, they need to cut rates, buy longer term debt. In a nutshell, that's what has to happen. Let's take a look at, first let's go to comments. See, there's a conversation going on here. Adam Taggart just interviewed Melody Wright on housing. She believes we are going into a downtrend based upon demographics. Boomers are aging. Yeah, well, we don't have the demographic problems of Europe and of in particular Russia, Japan. Terrible. Did you know that Russia has the same population as they did back at the end of World War II? Same size population. There is no intention of ever paying back the federal debt. If looking at it from a sane perspective, how could we? Anybody that's buying our debt right now, how could you, without cutting spending? I don't know how you could possibly hope that you're not going to be left holding the bag at the end of the day. But the question is, when does that balloon burst? That's what everybody's hoping for. They're hoping that the burst doesn't happen under their watch. Lee Cable, fast forward 6 months and the markets will look completely different from today. And the scary thing is that there'll still be talking heads on CNBC saying buy the dip. Yes. Yep, agreed. Okay, yep, agreed. All right, good stuff. Let's take a look at the weekly charts from last week. I'm going to go through these quickly. Some of them we may have already gone over. New highs, new lows. Okay, so on the week last week, I've been talking a lot about the negatives that are out there, but the positives from last week. We don't trade the market that we want. We trade the market that we have. Simple as that. So I can have my opinions, but when I take a look at the news highs versus new lows, clearly it was a bullish week last week. New highs surged relative to new lows. Baltic Dry Sea Index is a measure of the cost of shipping dry bulk goods. Not much activity here. We could skip it. Put call ratio. While the equity markets rallied last week, they were also buying protection on those positions. Put call ratio narrowed last week. So there were a lot of put buyers out there, more put buyers than sellers last week, even though equities turned it around by the end of the week. Bullish percent index. Bullishness sentiment on the NASDAQ composite, positive. Bullish key reversal bar. On the S&P 500, same chart, sentiment, bullish, rising, not overbought yet on either of these. We're at the upper end of the range, but they can go up higher. CRB commodity index. Now, this is what gets my attention. Usually, it takes a while for the markets to catch hold, but we watch this constantly. And you could see here that we had a bullish reversal bar. Let me take a step back. What's the CRB commodity index? It's a basket of commodities. So what tends to help drive inflation? Well, commodities, because you need stuff to build stuff. So CRB commodity index up on the week with the dollar moving lower. We'll go to the dollar in a second, and we'll talk about why that matters. Before we go to the dollar, I want to talk about the yield curve. Yield curve closed flat on the week. But as I mentioned earlier, on the month, this is not the chart I wanted. This is the one I wanted. On the month, we have a huge breakout here. So what the bond market is saying is that, okay, you're going to cut rates, but you're still going to have to pay more for those longer dated maturities because you're insane. I'm not going to lend you money for 10, 20, 30 years and hope to get paid back at only 4%. They want more. TLT, 20-year bond ETF, good week, closed up, not a breakout. Yields failed to break out. They had a 2-week back-to-back rally. You could argue that we had broken down. It's not an argument, it's a fact that we broke down here the week of July the 28th, retest 1, retest 2, rejection, and we go lower. That's a weekly chart, though. Let's take a look at a longer duration view. Let's go to a yearly chart. We've gone over this chart before. We are in a new uptrend. I'm so used to Trend Spider. Here we go. A new uptrend on a yearly time frame. That bull market that began in 1981 on bonds is over. It's dead. The path of least resistance is now to the upside. So 1 week does not a trend make. We've been consolidating for the past couple of years here, 3 years now. And at some point in time, this is going to get resolved. The question is, how rapidly does it evolve or devolve? Michael, welcome. Lee Cable, your point is accurate. It's very accurate. The problem is that the purchasing power of the U.S. consumer drops dramatically. So we import a lot more we import more goods than we would produce here. We're not a manufacturing economy as we were. We produce a lot of stuff, but not like we did. We're not like China. So the goods, unless the producer is going to absorb the difference in currency fluctuation, and they do hedge for currency changes, then the purchasing power of the U.S. consumer goes down, and that is inflation. So I know President Trump is going to try to get more manufacturing here. The question is what kind of manufacturing is it, and will it make a difference to the average consumer? The dollar. This is the third down week last week. The news out of from Jackson Hole last week was very dollar bearish. As for the euro, bullish key reversal bar, looks like it wants to go up. Japanese yen, multi-week consolidation now, looks like it wants to go up. Very bearish for the US dollar. Skipping XRP, we already talked about that. Dow Transports, major reversal last week. I mean, we saw a big failure last week right here on the 20th to hold this breakout. And we had a continuation breakdown on the 21st. Then on Friday, a rip your face off rally. So this is what I mean by we had a bull trap or a breakout point failure, but this was negated for the most part on Friday. Now, if you take a look at this from a macro view and say, okay, what if we fail to break out? What if we roll over here and take out the lows of August? Well, that would be extremely bearish. That would be a confirmation breakdown. You can expect a big sell-off in the equity markets. Right now, this chart looks as though, let's go back to the weekly chart. This chart looks as though it wants to go up. Might we get a retest of this support level here at 15,848? Sure. But it looks as though it wants to go up. Valuations be damned. Dow Jones Industrial Average, all-time highs last week, up 1.53% on below average volume. S&P 500 up over a quarter of a percentage point. New all-time highs last week. Volume was good. Let's go to the daily chart. Could have sworn we made all-time highs last week. I keep hitting the wrong button here. Yeah, but we backed off. So do we get follow through here, or do we fail? Do we close back down below the lows of the 20th? Odds are we go higher. Volume on Friday, save the week. Now, for the equal weighted, this is a view of the 100 on an equal weighted basis. We look at this to make sure that it's not just the Mag 7 names dragging up the whole market. And it wasn't. It was a broad-based rally last week with the equal weighted basket hitting all-time highs, now performing the S&P 500. Triple Q's weekly chart closed down on the week by just shy of a percentage point. But was volume? Volume was heavy. Equal weighted view. Triple Q's closed up. So Mag 7 did not perform as well as the beaten down names in the Triple Q's. But remember, going into the Jackson Hole speech on Friday, you only had 45, as of the close on Thursday, only 45 of the 100 names in the Triple Q's trading above the 50-day moving average. Was Friday a short squeeze? We're going to know very, very soon. IWM, huge move last week. I think it closed up 4%, just shy of 4% on Friday. So typically, the small caps tend to outperform the mega cap names during a rate cut regime, especially when you go out 6 months. And if you include September of last year, the full basis point cut, then it's time for the small caps to rally. The banks up 2%. They're looking good here. Volume was light. Technology closed down. So you could see there was a shift last week in terms of sector rotation. Dow Jones, all-time highs. S&P's right at all-time highs. Q's closed down. Technology down. Semis down. Software down. 1.51% for software on volume. Biotechs, good week last week, closing up. We're long of this. This is a leveraged product, not for the faint of heart. Staples, this is a retest. While it's not an overly bullish chart, I'm still going to call it bullish in that they were expecting a market sell-off. They started moving money into Staples before Friday as a hedge, as a safety play. And they sold them off the highs of the week. This looked beautiful early on in the week, but we still held the breakout point on Staples. I still think that they can move up higher. Daily view. They closed up higher on Friday. Thursday, they were down. Emerging markets. If the dollar goes, emerging markets are going to rip up higher. This is emerging markets ex-China. We are long of it. Very bullish, up a half percentage point last week. EEM with China up 1.38% last week. Emerging markets, if the dollar's weak, that's where you want to be. Cheaper and more upside potential. Energy really caught a bid last week. Energy closed up 3%. we have a position, not a big position, but a position in energy. But it looks as though we're going to rip up higher here. Volume is light. We'd like to have seen higher volume. Crude prices, we may have a higher low on crude. Bullish reversal bar on the week. Here's your higher low. Oil and crude are, oil and energy are highly correlated. As goes oil, so goes energy stocks. If we get a continuation breakout on oil, which I think we're going to, then energy is very, very attractive. And on a PE basis, it's far more attractive than the triple Qs. But who cares about PEs anymore? Gasoline prices rallied last week. Gold, bullish key reversal bar. Look at this wedge formation, triangle formation. It's getting ready to rip up higher. GDXJ, junior miners, up 3.23%. We're long of it. Nugget, mega cap, senior miners, leverage product. We're long of it, up 6.38% on the week. Palladium, we're long of it. I want to buy more. I said I was going to do this on Friday. I didn't do it. I got to do it on Monday. Reversal week, closing up 0.75%, a little bit more than that. Held 100. That's the price target I was looking at. It held. It reversed. Bullish. Silver, leverage product here, up 4.6%. Let's go to SLV. Bullish key reversal bar. I think we're breaking out to all-time highs. Silver miners doing beautifully, up 2% on the week after being down big on the week. FLNG, we're long of this. This pays us a 13% dividend. When we bought it, it paid a 13% dividend. Still great dividend here, yielding 11.76%. We're long of it, not for the weekly chart, not for the daily chart, but for the monthly chart. And the monthly chart, new monthly higher highs. We're breaking out of a major base. I'm extremely bullish on liquefied natural gas. EOG Resources broke out last week. We're long of it. We're going to be looking to add more. Boeing, long of it, stalled out here. Let's go to the Friday's price action, which was good. A little bit of topping action. Still bullish. UNH, we call that bottom down here. We are nicely in the green on UNH. I have multiple videos on YouTube on UNH and on CNC, which are also long of. We're using UNH as our investment vehicle because it pays a dividend. CNC, I have more shares of CNC, but it's a swing trade vehicle only. I'm not going to be holding it for all too long. I'm looking at a price target between 35 and 40 bucks a share. Then we're out. But I will carry UNH longer term as an investment. Another name in that sector is Molina. I kept calling it Mohawk for the first couple of weeks I was tracking it. For whatever reason, MOH makes sense. If it was called Mohawk, that would probably be its symbol. Closed up just shy of a percentage point on the week. Lots of topping action in there. So we may get a higher low, may get a sell-off here on Molina. Let's do some chart requests. We'll call it a night. Where is it? Folks, we're going to be using our friends over at TrendSpider. So take advantage of our 35% discount code below, CON35, CON35. Let's kick this off with first seasonality going into this new trading week. And by the way, I didn't go over this because I'm just looking at it now. This is a monthly chart of the S&P 500. We hit a massive resistance level last week, and we closed there, right here. This is the automated trend lines. I didn't even know it until now. Let's check out the trip Qs. Triple Qs are at resistance as well, but these are my manually drawn lines, but they're still very good. Very proud of my manual drawn lines. All right, let's check out the seasonality here of these names. Let's go weekly view. Remember, folks, September is the worst month for the S&P 500. This coming week here, where the dotted line is, that is today and next week, this coming week. It's usually a pretty good week. It's the following week. That's a bear, pardon the pun. Kind of intended. Let's check out the trip Qs. Seasonality. The same as for the S&P 500 and one of the not so great weeks out of the year. Not this week, the following week. All right, let's go to requests. All right, we got Nouget. No. Nugget. No. Franklin's question is time to take profits on Nugget. I don't think so. Let's look at the chart. I don't think so. Anecdotally. First, let's take a look at the seasonality since I have it up here. Next couple of weeks are not so great, but let's face it. You know, these names have been out of favor for a long, long time. So I don't really think that seasonality is valid with the mining stocks. Nobody's wanted them for a long time now. So I'm going to pass on seasonality for the mining stocks. Now, taking a look at the weekly chart, I mentioned a couple of weeks ago, I thought we were going to par 100 on Nugget. I still think that. I think we could get there this week. We're going to have resistance at or around 103 per share. So we may get a retracement on Nugget off of that resistance level. But I remain bullish on the mining stocks, gold mining stocks, Palantir, PLTR. All right, so here's your revenue growth. It's a monster, but it's extremely expensive. Extremely expensive. We really have no overhead supply here. We're just off of all-time highs. So we can only say, all right, here's our resistance level right here. It did not perform well last week. It rallied off the lows of the week. Let's get rid of this. If we do break out, this is going to act as the rising upper band of resistance in white. Let's do this now. We broke support last week. We broke weekly support. Might we rally? Yes. 171.29 in that ballpark. Could be 172, 173. We're probably going to get a check back this week, and we'll see whether or not we get rejected on Palantir. But it was not a great week last week. You got to ask yourself the question, you know, Powell delivered on what the president wanted on Friday. So now we have to ask ourselves the question, I think it's a reasonable question, especially with Palantir and its valuation, is this: was it all priced in? Is it a sell the news event? I don't think we could discount that question. So not great price action on Palantir. Let's go to the daily chart. Even on Friday, we didn't close at the highs of the day. Volume was okay, but we sold off the highs of the day. So I'm not bullish on Palantir right now. Silver, we already took a look at. Let's go to the weekly view first. I think that this is like a launching pad. This is my manually drawn trend line here, but it's clear where it just wants to go up. It wants to go up. So I think that we are breaking out, and we could quite possibly on SLV be heading up to 41 bucks a share. Daily view, good stuff. We broke out on Friday. Here's your breakout point on SLV. Good stuff. I think it goes up higher. Bullish. CRWV for Mark. CoreWeave. I'm not familiar with this company. I think market's in a downtrend channel. And weak stocks tend to get weaker. We are at the lower band of that channel. We've bounced a little bit, but volume is very, very heavy, well above the average. So this tells me that you have institutions that are unloading positions here. So I don't want to get ahead of these guys because they can make your life miserable. On a daily chart, again, automated trend lines, you could see that we have support immediately below here at 88.42, then below there at around 82.50. Let's bring up the Fibonacci's. We bounced off of Fibonacci support last week, and we fell just shy of hitting resistance. I'm not a buyer here. There's just too many other things out there, especially in the healthcare arena that I like. In the biotech sector, they're looking really good. Early stages of a bull run here. Potentially the banks are looking good. So I would avoid this stock right now. It's just not behaving well. So I would let's revisit it when that weekly down volume dries up a little bit and we begin to have a few weeks of sideways consolidation. Then let's revisit it. FNMA. All right, so it's funny you bring this up, Lester. I hadn't even thought about Fannie Mae in I don't know how many years, but it was brought up on that Peter Schiff podcast I mentioned earlier. And it looks like the Trump administration is going to want to revitalize these agencies. And that's probably why you're seeing the share price move up higher. Now, we do have on a weekly chart some pretty serious resistance. But if we get a close above 12.20, 12.50 per share, it's probably going to be a good entry point. I think it's a very bullish chart. This is the monthly chart, and we've broken out. It's a continuation breakout. It's doing what a bull market is supposed to look like. You rally, orderly pullback, you stair step up higher. Good stuff. I don't think it's the best of quality of names, but you can't argue with the chart. FMCC, another one of these quasi-governmental. It's bullish. It wants to go up. Monthly chart, same chart as Fannie Mae. All bullish stuff here. We closed above weekly resistance on FMCC, which we didn't on FNMA. So we have the breakout. This to me looks like a better buy than FNMA right now. If I had to pull the trigger, I would go with this one first. Daily view. Yeah, you're going to get a little bit of resistance up here at 10.20 per share. And hopefully I didn't miss anybody. 1, 2, 3, 4, 5. I think I did. I almost missed George and Paul. CC. I haven't seen this one in a while. Good looking base. And this goes back to Paul's CoreWeave earlier, or Mark's CoreWeave. Sorry. What you want to see is this. Stock and distressed. Then all of a sudden, the volume, which was heavy back here, drops down like this. Everybody forgets about it. The institutions are done selling. And then it just does one of these numbers. Backs, fills, and forms. A nice little W formation. Then you get a breakout. And then you start to move up higher. And that's what you're seeing here. You're seeing now you're getting higher lows and now higher highs. So weekly chart, CC looking good here. Daily view. great stuff. I mean, great day on Friday. It responded very, very well to the, I'm assuming no other news was out there. Fact check me on that. But it responded well to the rate cut talk and wants to go up. Looks like it's bullish. PEP. All right, so I like PepsiCo. I think the thing to keep in mind is that it's a mega cap, boring staples play. I like staples plays. The problem is that PepsiCo is very, very weak relative to other staples, and it's not behaving well right now. It's had a nice consolidation, a nice rally last week, bearish reversal bar on the week. We've seen this show before. We saw it back here. What you need on Pepsi is a pullback and a higher low, a massive W formation to form. We had an instance of that back here. We pulled back, rallied, pulled back, W formation, breakout, new rally. So I'm not bullish on this. I think you're chasing it here. Let's go to the daily chart. You have a lot of overhead supply. It's had a nice run this month. I think you're better off looking in the small to mid cap space for stocks that are profitable and probably have better valuations than the mega cap names. And nobody wants staples right now. I mean, not this staple, the staple index. I mean, Altria did really, really well. You take a look at if you wanted to buy a staple, go with best of breed. You know, even Altria closed down on Friday, but look at the difference in charts here. Here, just take a look at the XLP. Look at the difference. Higher lows, higher highs on a weekly time frame. We closed green week. MO, higher lows, higher highs, very extended here. Now look at Pepsi. You know, the charts draw themselves. It's a no-brainer here. Now, that doesn't mean that there might not be something good happening here, and there may be value. There's not. Their revenue growth is not wonderful at all. At all. So I would avoid this. It's clear the reason why the street doesn't like it right now. Revenue growth is horrible. Last one up, XOM. I'm going to be more bullish here, I think, on XOM. Yeah. We remain in this triangle formation I drew probably a few weeks ago. Revenues are struggling. I can never remember Chevron's ticker. You know, same thing here on revenues with Chevron, but I think these stocks are going up. I think they're going up. I think the reason why they're going to go up is because just look at the CRB commodity index. You have the dollar going like this. You're going to have cuts in interest rates forcing the U.S. dollar down. What's oil still priced into this day? Dollars. So weaker dollar causes prices for oil to move up higher. Commodities are probably going to be the place to be, just like gold is right now. They're cheap. They're cheap. So I'm bullish on these names: CVX, XOM, EOG. We own. We're probably going to be adding more to that as well, folks. Everybody have an awesome remainder of your Friday, and everybody have a profitable trading week. Thanks for being here. Don't forget about the discount code on TrendSpider, CON35. Link below on YouTube, link above on Facebook and Twitter. Have a profitable trading week. Like, subscribe. You know the deal.